Today, we will talk about gross margin, definition, example, formula, and how to calculate. Gross margin is a profitability measure that looks at a company's gross profit compared to its revenue or sales expressed as a percentage. It is determined by calculating gross sales and is a key indicator of a company's financial health. The gross margin is calculated by subtracting the cost of goods sold from net sales and then dividing it by net sales. Net sales are equivalent to revenue and represent the total amount of money generated from sales for a period, while COGS includes the direct costs associated with producing goods. The gross margin measures the percentage of revenue left after COGS and helps companies understand the relationship between production costs and revenues. It can be used to assess company efficiency, compare different companies, and make strategic decisions, such as cost-cutting or price adjustments. While gross margin focuses on the relationship between revenue and COGS, net margin takes all of a business's expenses into account. It is the percentage of net income earned of revenues received, providing a broader view of a company's overall profitability and financial health. Gross margin and gross profit are different measures of profitability used by companies. Gross margin is expressed as a percentage, while gross profit is expressed as a dollar figure. Gross profit is calculated by subtracting COGS from a company's revenue, providing insights into the money earned after production and sales costs. Gross margin is calculated by first finding the company's gross profit as a dollar figure by subtracting COGS from revenue, then dividing that figure by the total revenue and multiplying it by 100 to express it as a percentage. Gross margin and gross profit are two different metrics used to measure a company's profitability. While both factor in revenue and COGS, gross margin is expressed as a percentage, while gross profit is expressed as a dollar figure. The ideal gross margin varies by industry, with service-based industries tending to have higher gross margins due to lower COGS, while manufacturing companies may have lower gross margins due to larger COGS. Gross margin is a key figure to assess a company's profitability and financial health. It can help companies identify inefficiencies, make strategic decisions, and increase profits. However, it should be considered along with other financial metrics to get a complete view of a company's performance. Here are 5 key takeaways. 1. Gross margin measures a company's gross profit compared to its revenues as a percentage. 2. A higher gross margin means a company retains more capital. 3. Gross margin is also commonly referred to as gross profit margin. 4. If a company's gross margin drops, it may cut labor costs or source cheaper suppliers. 5. While gross margin focuses on revenue and COGS, the net profit margin takes all of a business's expenses into account. Hope this would help. Thanks for watching.